Greetings and welcome to MGO's webinar, Navigating the 2025 Tax Shift, What Your Business Needs to Know. We'll be discussing the reconciliation bill that's informally known as the One Big Beautiful Bill. The bill represents the tax and spending policies that form the core of President Trump's second-term agenda. In addition to the tax provisions, the bill includes funding for defense, immigration enforcement, and reductions in other programs. Today, we'll focus on selected tax provisions that primarily affect businesses that we believe will be relevant to you. Our agenda begins with a short introduction of our panelists and an overview of the bill. We'll start with the impact on businesses and individuals, move to energy tax credits, cover very miscellaneous tax implications, and finish with a question and answer session. During the presentation, you can use the question and answer feature to ask questions, and we'll do our best to address them in real time or at the end of the presentation. A short introduction to MGO. We're a team of financial services professionals specializing in insurance, tax, consulting, outsourcing, and private client services. We have over 500 team members in 15 offices worldwide ready to address your needs. Our panel today includes Mike Silvio, tax partner and MGO's real estate industry group leader. Brad Hall, tax partner who heads up the private client services industry team. And Danielle Bradley, director and our credit and incentives leader. I'm Ron Martin, MGO's national service line leader of tax. As mentioned earlier, this is a reconciliation bill which allowed it to avoid the 60-vote Senate filibuster. The bill, signed July 4th, passed the Senate 51-50, with Vice President J.D. Vance casting the deciding vote. It's important to understand the effective dates of the provisions, as some are effective January 1st, 2025, others are later, and there are several phase-ins and phase-outs that are notable. Estimates of the cost of the bill vary widely. The Joint Council on Taxation has estimated that the bill will result in $4.5 trillion in net tax cuts. The Senate's estimate is a net tax cut of $715 billion, using a baseline projection that assumes the temporary provisions of the Tax Cut and Jobs Act of 2017 have already been extended. That approach wipes out the cost of extending the 2017 tax cuts. In any event, the bill offers both tax cuts and increases that will affect nearly all businesses and investors. Let's jump right into our presentation with provisions that impact business and individuals. I'll turn it over now to Brad and Mike.
Good morning, or good afternoon, good evening for all of you that are joining. I guess the first item that we'd like to talk about is the increase in the state and local tax deduction. That's your real estate, your state and local tax increase that's been limited to $10,000 on itemized deductions since 2018. It was with the 2017 Tax Act. So that's been in place since then, and it's increased fourfold to $40,000 effective January 1 of this year. Going through the end of 2029, so it's a 5-year run. Unfortunately, there is a phase out when modified adjusted gross income exceeds $500,000, completely phased out back to the $10,000 limit at $600,000 of income. And it's 30%. There's a 30% reduction dollar for dollar as you exceed that $500,000. So it doesn't necessarily assist or help all of our high net worth and net income clients that exceed that $500,000, but it is going to help all of those that do itemize that up to that level. They actually call the change, it's called a SALT torpedo, where there's a phase out between the $500,000 and $600,000. So that's the increase in the SALT deduction, and this will increase a lot of itemized lot of folks that are itemizing their deductions starting in 2025 that have been taking the standard deduction. Mike, did you want to talk about the PTE tax?
Sure. Sure. Let me welcome everybody as well. Appreciate everybody getting on. I know this is a very, very significant time of year with this new tax bill that passed, so hopefully we can provide some light on that. Just wanted to, for just a second, tell you a little bit about kind of the PTET. For those, maybe as a refresher, this became, because of the SALT cap, we had the PTET that kind of came into being, and many states applied for this and worked through it, where the entity that's a pass-through entity can actually take deduction for the tax paid on the owner's behalf. So that's really what we're talking about here. Because the cap was 10,000, it made more sense to do PTE. Still probably makes sense to do PTE, even though the cap is now 40,000. But as Brad said, you're going to see a lot more people utilizing the $40,000 cap in their itemized deductions.
And that brings up a good point, Mike. I mean, there's a lot of folks that may have been doing the PTE tax through their business that now that they get the deduction on their itemized, they don't need to do that at the corporate level. So I think that's
Correct.
That's a great point. I think it's going to take a lot more analysis with your CPA to determine whether or not you do the PTE tax or you elect to just deduct it on your itemized. California recently pushed through an extension of 5 years. They're going to 2030. So California does allow for pass-through entity tax. So that's new and improved. So that's it. Anything else that you wanted to talk about? Let's move on to the next slide.
One more thing, Brad, just stay tuned for maybe some things that may change with state legislation in this area, because now that this cap is 40,000, we can see that California has already jumped on this and made a change, as Brad talked about. So just watch your different states to see what they do with it, if they extend their PTE requirements or time frames or anything like that.
Next slide. Okay.
Okay. I'll start on this, and Brad, you can jump in if you have anything other to say. So research and development has been kind of a bane of everybody's existence for a while because of the TCJA and because of the capitalization of the 174 costs and then amortizing those over 5 years for domestic and over 15 for international. With this bill beginning, now you can see it allows for immediate expensing of all those costs for tax years beginning after 2024. So we still have the 24 year to deal with where we have to capitalize those costs and expense them. However, in 2025, we can go back to expensing those 174 costs again. Now, 2 rules came in here. One is for small business taxpayers, and then another one is for all other taxpayers. So small business taxpayers with a 3-year average annual gross receipts of 31 million or less now have the opportunity to do 2 things. One, look at your 22 to 24 returns, and those unamortized costs on those you can amend those returns and pick up those costs, change your taxes, get refunds back, or you can elect to take that unamortized portion and take it either in 24 or 25. So 1 or 2 years, you can take it over 1 or 2 years. That's if you're a small business taxpayer. If you're all other taxpayers that had to capitalize these costs, you can now elect to deduct these over the next 2 years, 25 and 26. So that's really an impetus. This provision is permanent, which was interesting because when the House bill had it only for 5 years. So the final bill now shows it's permanent. And you can see there's some pros to this. It's going to enable forecasting for R&D. It's going to promote innovation in this country. It's going to increase cash flows for companies. With the retroactive application of the R&D, all that tax that companies paid because of the unamortized costs will now be able to get back in one way or the other. The con is international costs still have to be amortized over 15 years. So just keep that in mind. Brad, did you have anything more to add to that?
Yeah, just that there is that option for the small businesses with averages of 31 million or less. They can elect to either go back and amend the 22, 23, and 24 tax returns, but it's both corporate and personal. That can be a big deal, big challenge, or you can just force it and run it all through in the 2025 tax year, which I'm sure that's what most businesses are going to do to not have to hassle with the amendment process. So that's it on.
And I think one more thing, if you were a company that kind of took your foot off the gas with regard to R&D and innovation and new product development, et cetera, I think now this gives you the opportunity to look at that afresh and say, okay, we're going to get back into the research and development world and innovate again.
Yep.
Okay, not going to spend too much time on this, but there have been a few little changes on the ERC area. The changes really implement additional penalties. So there's a new 20% penalty for erroneous refunds. There is also a $1,000 promoter penalty for those promoters who were basically ERC mills and they did no due diligence. They just kind of filed the claims. So there's also the barring of an allowance for any ERTC refunds not yet issued for the third quarter of 21 if the claims were not filed by January 31st of 24. So if you have a Q1 or Q3, excuse me, of 2021 claim that you haven't got anything on yet, you may not get it because of the new bill. So just keep that in mind. The statute of limitations also increases to 6 years for the IRS. So what I want to say to this is if you have filed your ERC claims and there are a lot of taxpayers that still have not received their refunds, if you get your refunds and because of this new enforcement, you feel like you may want to not cash those refunds because you're questioning whether or not you qualified, you still have the opportunity to not cash those refunds and back out of it with no penalties. So that still is an option under this law. So just wanted to make that clear for everyone.
We're taking a moment for a polling question.
Ron, are we ready to move?
I think we should be ready. Carly, we ready? Yep, results here. We're going to show them later. There you go. So what's your level of concern about the IRS enforcement related to the employee retention credit? Looks like most people aren't that concerned or just really not sure yet. So something to look at if you have outstanding.
Think about. Yep.
So I'll take this related to overtime pay. I mean, I don't think, a lot of us or a lot of our clients are concerned about the tip exclusion. Again, this goes up to $25,000 a year. The overtime pay and the tip exclusion are a deduction for the employees. And it's phased out for those single over 150,000 of income or 300,000 married filing joint. And that does go back retroactive to January 1st. Most of businesses will have to report their overtime pay and their tip income on their W-2s. But the payroll taxes will be identical. There will be no changes to the cost to a business related to the overtime pay and tip deduction. Let's go to, I know that there's some compliance issues because you have to be able to report that. And I know that goes retroactive. So just understand that if you haven't got a system that does track that, you're going to need to have it by the end of the year. Next
And I think
slide.
Brad and I were talking about this, and I think what you're probably going to see is you're probably going to see something on the W-2 that will now a box that's going to be checked, or a number that's got to be put on there for the tip or the overtime or something, so that it can be put onto the individual's tax return, because it is above the line deduction on the individual return. So there will be some compliance there that you're going to see.
In the next slide, from a business tax provision update, one of the biggest one here is the increase for next year. This goes into effect January 1st, 2026, that the threshold for reporting on 1099s, NEC, miscellaneous, Ks, etc., goes up from $600 to $2,000 a year, which is going to eliminate a ton of reporting requirements for all businesses, because again, it's tedious to have to file these 1099s, and then they're going to adjust it from the 2000 starting in 2027 for inflation. So that's exciting for most businesses that will no longer have that need. Next slide, please. Okay. Mike, do you want to talk about the
Sure.
199A QBI?
Yeah, so the 199A has been around for a while, and a lot of us are probably very familiar with it. So we'll just kind of run through these changes relatively quickly. So the 199A now becomes permanent. So if we recall, under the TCJA, it was going to sunset. So now it's permanent. There was talk that they were going to change the percentage of the deduction to 23%. But with the bill, it finally came down to it that they kept it at 20%. What they did, though, was they expanded the phase-in window. So the phase-in window used to be 50,000, and it's really a range: 50,000 for single filers and 100,000 for married joint. Now it's 75,000 and 150,000. So really, what that means, if you're a specified service, trade, or business, is that you had a phase out. And that phase out really started around 394,000 to 494,000. That was the $100,000 phase out that you had. And once you got to that phase out cap, or that 494, you lost your QBI deduction, right? So now you have $150,000 to play with rather than 100,000. So more people will be able to take the QBI deduction than before. But understand, this phase out only applies to SSTBs. So that would be doctors, attorneys, service companies, actors, actresses, accountants, those kinds of things. So a very good provision. This is really good. They made it permanent. So
yeah, and essentially all businesses pretty much qualify. Most businesses qualify for qualified business income deduction of 20%. And these are on pass-through. That's going to be your S corps, your partnerships, your LLCs. It does exclude C corporate income. So that 20% is a big deal, that it's now permanent, which really is an incentive to consider being a pass-through entity versus a C corp. Next slide, Carly.
Mike, Brad, a question came through. Are 1099 requirements changed to 2000? Is that for reporting year 2025 starting in 2026?
It's the 600 applies to 2025, and then it goes to the 2000 and 2026. So anything over 600 has to be reported in this year. So it's the change effectively is 1/1/2026.
Great, thank you.
And before we move on, we'll just touch real quick on the business interest deduction. So companies that really kind of realized this was companies that had interest expense and had it limited because of a certain limitation calculation, which usually was earnings before interest and taxes. What they went back to now was earnings before interest, taxes, depreciation, and amortization, EBITDA. So that increases the limitation. So what that means is a lot of companies will now be able to deduct more of their interest before they get to that limitation. So this should also spur more deductions and save more tax. And I've had companies that are in this business interest deduction limitation. So this will be good for them. And this provision is permanent as well. Brad, I don't know if you had any more thoughts on
Nope.
that or.
Nope, depreciation.
Okay.
This is a big one. The code section 168 depreciation for 2025 is down to 40%. It was 40%. Next year it was going to 20% in 2026. So this was being completely phased out. The Big Beautiful Bill has increased it from 40 to 100, back up to its 100, which is what it was 4 years ago. And this allows for fully deducting 100% of assets that are purchased for your business. And I say that mainly personal property, equipment, fleets of trucks, etc. So you can see that it applies to machinery, equipment, and life's anything. It's basically a life that's less than 20 years qualifies under the 100% bonus depreciation. This is for all assets acquired starting January 20th, the day after the president was sworn in on the 19th. And Mike, do you want to talk about the cost segregation studies?
Sure. I think cost segregation studies will become more important and they'll become more valuable. I've already had a number of clients calling me about, cost segregation on new buildings and all of those kinds of things because of the 100% now back into the bonus depreciation. So if you're looking at purchasing a building or doing any improvements after that date of January 20th, you should look at the cost segregation study because it becomes a way to accelerate your depreciation. And if you could only accelerate your depreciation using bonus by 40%, as Brad talked about, okay, maybe that wouldn't be, something you'd want to, kind of look at. But if now you can look at it and accelerate some of that 5, 7, and 15-year property to 100% and deduct it all, that could be a large tax savings against your rental income. So that's where I think this is going to come into play.
Yeah, the other thing is the code section 179 expense was doubled, went from 1.25 to 2.5 million. The phase out went from 3.1 million to 4 million. So this is a big deal as well. I'll give you an example. If you buy an SUV business that's 100% for business, now you not only get the 179 deduction of 31,300 against, say, a $75,000 vehicle, and then now with the increase on the 168, you'd get the full 43,700 as a 168 deduction, allowing you to deduct 100% of the vehicle in the year that you purchase it. So that's a big deal. Again, that only applies to vehicles acquired after January 20th of this year. Okay.
Two questions.
One other thing about the 179 that's kind of interesting is on a cost seg, you have part of the cost seg is, roofs and HVACs and all of that. Those are not qualified for bonus because they're typically a higher life than 20 years or 5, 7, and 15 years, but they could qualify for 179. So you could look at it from a two perspective and say, okay, what can I take as a bonus on my cost seg? And then what else can I use the 179 for? So that's one reason to kind of look at both of those.
Two questions came in during this section. First one is, can I please get clarification on whether or not as a single taxpayer, does the $500,000 income limit apply, or is that only for married filing jointly?
It is for both. The difference is it's 250,000 for married filing separate.
Okay. And thank you. And the second question, is there a phase out of the 100% bonus, or is it 100% through the bill's life? Also, when does the bonus end?
Yeah, there is no phase out on the bonus. It is permanent. There was a phase out in the House bill, but they took that out, and so now it's permanent. So we're back to the days of 100% bonus depreciation like we used to before.
And one more, apologies. If wanting to write off a work vehicle, does it need to be paid off at the time of deduction, or can you still have a loan?
You can have a loan. If you cannot, typically you would not lease. A lease would not be eligible for the expense deduction under 179 or 168. It would have to be purchased. And whether or not you finance at 100% does not have any impact.
Okay, polling question number 2. How has section 174 impacted your company's R&D and tax planning? And our options are significantly, major cash / tax impact, somewhat, made adjustments, nominally, limited R&D activity, or not sure. We'll give everybody a few minutes to register the poll, and then we'll give you the results.
Like, it'd be nice to know how many businesses actually use R&D and how many eliminated R&D during the 174 capitalization years 2022, 23, and 24. And that all of a sudden now in 2025 they're back on claiming R&D.
Yeah, unfortunately, Brad, many companies did that. Many eliminated their R&D, and now hopefully they're coming back to doing it again.
Okay, so about 8% said it significantly impacted them. We've got 10% somewhat, minimally at 36%, and 45% are still not exactly sure.
Okay, moving on.
Okay, we will now turn this over to Danielle, who will speak to the energy tax credits.
Yes, hi everyone. In relation to the bill that passed, there were a variety of credits and incentives that were either modified in more of a favorable or potentially unfavorable way with some of the restrictions and timeline requirements. One of those that it was impacted the most is energy. So wanted to spend some time giving an update in terms of the most material opportunities we see for clients of ours, but also for proper planning so you can be aware of anything that's crucial when it comes to timeline requirements for the remainder of this year in 2025, but also looking forward into 2026 and beyond. So shown on the screen, these are the 4 primary areas that we see opportunity for with our client base, both in terms of businesses, but also for tax exempt entities such as state and local governments and tribes that we also service for. All of these credits are tied to the Inflation Reduction Act that was signed into law a few years back, and that allowed for what's referred to as elective pay for tax exempt entities to also get benefit of a refund or return on their investments in this space as well, depending on the credit and if it was identified as being one of those eligible for elective pay. Of these 4 that are shown on the screen, I'll go into more depth on what the updates and changes are for each. But starting at the top, energy property, this relates to 2 credits, both referred to as it relates to investments. And this has one of the largest rates of return at the baseline of 6% all the way up to 70%, depending on the type of investment, whether or not you meet eligible bonus criteria or received allocations also from Department of Energy. Energy production, this is a credit that's issued based on kilowatts and dependent on the type of renewable energy or electricity that you're generating and therefore selling to an external party. The two on the bottom relate to fleet-based investments. So clean vehicles, this is a credit when we think most traditionally for electric and hybrid vehicles, both passenger, but also those that are more significant, such as buses over a certain size requirement. And then the final one is the alternative fuel infrastructure tax credit, which most commonly is referred and referenced for electric chargers that are then tied to vehicle-based investments. So going to be going through each of these more in depth. Next slide, please. Continuing the conversation with some of the fleet-based improvements and also from a timeline requirement, one of the most crucial deadlines that has changed is relating to the commercial clean vehicle credit. So this was a credit that's issued for electric and hybrid-based vehicles that are from a qualified manufacturer. So when we think about those most commonly in the US, Ford, for example, that is a qualified manufacturer. If it's a passenger-based vehicle, this credit has been capped at $7,500. However, for those that are more significant, such as a city bus, those could be upwards of $40,000. Originally, this credit was going to expire in 2032. Now that has changed and it has accelerated that expiration to September 30th of this year, 2025. One item I do want to connect on is that place in service date. And place in service is with the intention of use. So it isn't necessarily that you've paid for that vehicle. It may or may not have been delivered, or it's delivered on that September 30th date, but there does need to be use tied to that vehicle by that September 30th deadline, which is quickly approaching here in the next 2.5 months. So these are still eligible, but a suggested action is if you have anything that you're anticipating for the remainder of this year, that you prioritize and accelerate those deadlines to not lose out on potential benefit that may have been planned for Q4 of this year. Next slide, please. The other fleet-based investment opportunity has been the infrastructure tax credit that's most commonly tied to electric chargers, either in parking lots or other structures for our clients. Originally, this credit was set to also expire in 2032. This credit is also unique in that there is a census requirement. So instead of the other credits just based on what type of investment that you're making, this credit is also dependent on where. And either meeting one of two eligible census-based zone tracks. With the bill change, this has accelerated the expiration with the place in service date of this infrastructure and investment to June 30th of next year, 2026. So while it does have a little bit more time, we're looking at just shy of a year from now, you do have to ensure that those place in service dates are going to meet that June 30th date of next year. The credit, to give some background, is either a 6% or a 30% return that has a ceiling of $100,000 on a port-by-port basis or a charger-by-charger basis, since some of these electric chargers, for example, will be dual port in comparison to single port. And the difference between that 6 and 30% rate of return is whether or not your project meets prevailing wage and apprenticeship requirements. Our suggested action is to also accelerate these place in service dates for anything in this current calendar year for the remainder of 2025, if possible, but also Q1 of next year into 2026. The reason for that is our clients on average see a construction time period of about 2 to 3 months. So depending on how long it'll take to identify a contractor, make sure that that work is properly integrated and tested, and you receive verification for use, that you're taking that into account prior to the June 30th date of next year. Next slide, please. Transitioning into energy properties, as mentioned, this credit is one of the most significant in terms of areas of opportunity with the rate of return that you'll see on the graph on the left, based on 6% minimum all the way up to 70%. The difference in the dark blue and the light blue ranges that you're seeing is similarly related to whether or not a project meets prevailing wage and apprenticeship requirements or meets an exception depending on whether it is under a certain megawatt allocation. In the various columns, you'll also see one thing to point out, the different stackable bonus credits that are available, such as if it's located in energy community, domestic content, which is based on where you're sourcing materials for steel, for example, and then the final application-based allocations, which are done prior to the start of construction and can add an additional 10 to 20% of a rate of return. On the right, these have been outlined in terms of the potential eligible projects. What we see most commonly for our clients: solar, geothermal, biogas, energy storage, for example. However, I've highlighted here solar and wind more specifically because while all of these historically, prior to this bill being signed into law, were identified as equitable and treated the same, that now has changed. So now if you have a solar or wind project, those are being looked at differently in comparison to some of the requirements or timeline restrictions of all of the other renewable energy investments and projects. Under the new bill, projects do have to begin construction before 2034 to claim the full credit and qualify, but as mentioned, solar and wind are going to differ slightly. So next slide, please. On the topic of solar and wind, so for the investment tax credit, as mentioned, that shows the various graph. Production is going to also differ depending on year and when you're introducing that investment. But for wind and solar, it is now going to be dependent on both the start of construction date, which is different than the other renewable projects that I mentioned for 2034, but also when you're placing that project in service. So how the bill's been written is if you start construction, you've already started, for example, now, or you plan to do so, but within 12 months of the enactment of this bill, which high level is end of June of 2026, since it was signed early July of this month, you won't be subject to an accelerated place in service deadline. So typically with that and just general construction, that's going to happen within 4 calendar years of when your construction began. However, anything that's outside of that 12-month cycle, if we think July of 2026 onwards, that now has an accelerated expiration for place in service date of December 31st of 2027. And what that means is essentially they're trying to restrict more of these wind and solar investments. They are most common and very widely accepted depending on location. So if you have a project that currently you have timeline restraints or you're looking into 2026 and 2027, it's going to be crucial that you identify meeting those deadlines, and anything that you have maybe planned after, such as 2028 beyond, starting construction within 12 months to avoid being ineligible for the credit. One of the other restrictions that has been added now for both the investment and production tax credit is what's referred to as prohibited foreign entity restrictions and material assistance. So there are now provisions that focus on foreign entities that are involved, as well as where you're sourcing materials. And if you start any projects with construction prior to the end of this year, 2025, you won't be subject to these additional requirements. However, if you start construction into 2026, 2027, or onwards, you therefore now also have to be more stringent on where are you sourcing materials from, who is related, to avoid being ineligible regardless of the type of renewable investment you're making. So our suggested action is that you meet with departments or within your business unit to identify those project timelines, what needs to be prioritized for those construction dates, as well as assess any foreign involvement or where you're sourcing materials from that may now require ineligibility of those projects. Next slide. We've summarized high level between where we're at right now, July of 2025, into next year, June 2026 and beyond, with what is most crucial for you to do now and some of these critical dates. So right now, as a reminder and summary, we're requesting that you do a review of those in progress and planned projects, so that way you can identify where some of these issues may occur in the timeline that you're seeing. September, as a reminder, that date for place and service for commercial clean vehicle credits and to still be eligible for those investments. December of this year is the last date for projects to start construction and not be subject to the prohibited foreign entity restrictions and material assistant restrictions for the investment and production credits. And then June of next year, we have both the place and service date requirement for the refueling equipment credit, but also that critical date of the 12-month start of construction for wind and solar investments to therefore be eligible or ineligible or subject to the 2027 place and service date requirement. Next slide. So as a reminder, plan ahead, look at those timelines. There is a sense of urgency because of some of those credits being more restrictive, and to ensure that you're not missing out on potential opportunity or modifying for these restrictions as it comes to timeline or the place and service and construction dates. What we recommend is that you look at this strategically. You are identifying allocations that may be eligible for you to submit documentation on. You're also looking at opportunities and consulting with legal, tax, and engineering teams to stay agile. And then final slide, one item I wanted to mention, on these elective pay credits, we do have those listed on the left. We are having a specific webinar as a follow-up to this one for public sector and tribal leaders that have some of those timeline restrictions. So if that is applicable to you, you can certainly scan this QR code and then register for that webinar that's taking place in 2 weeks.
Danielle, a question came through that says, can you please elaborate on the investments credit for tax exempt entities? Is that something you'll be covering in your webinar?
Yes, so that'll be covered further. That is what we're referenced for the 60 to 70% rate of return. So solar is an example of the investment credit, but we also do have a one-pager we can make sure is shared following this webinar as well for reference. And polling question 3 that we have, how prepared is your organization for the potential rollback of clean energy credits? Fully prepared, timelines are already accelerated. Somewhat prepared, you're evaluating options. Not prepared, waiting for clarity, or not applicable. Okay, looks like we're split either between not applicable, but then also not prepared or somewhat prepared for the remaining group. And I'll pass it back to Brad and Mike for additional tax implications.
Thanks, Danielle. Next slide. Okay, so one of the big provisions in the big beautiful bill was the permanency in the estate tax exclusion that became a solid, it's going to become a solid 15 million for singles, 30 million for joint filers or joint couples. And that 30 million again is permanent, and it is going to be indexed for inflation starting in 2026. So 2026 is when it comes in to play at 15 million. And it's currently for 2025 at 13.99 million. roughly double that for a couple. So the overall increase is $1 million for individuals and $2 million for a couple. Again, as many of you know on the call, there was, prior to President Trump being elected, there was discussion on taking the exemption down to 7 million. And actually Harris wanted to drop it to about 3.5 million. So that would have been 7 million for couples. There's currently about 225,000 ultra high net worth individuals in the US today that have 30 million or more in assets. And that is about 626,000 worldwide. Again, those are considered ultra high net worth individuals. So in the US, it's just about 0.25% that have in excess of 30 million. So this is going to basically exclude 99% of the US population with this $15 million exclusion. So it's great to have this finally passed. And again, it is permanent and it will be indexed for inflation moving forward. Next slide. Mike, do you want to talk about the 1202?
Sure. So Section 1202 has been around for a number of years now. I think it came into law in 1993. Basically, the impetus is to really try and get folks to invest in C corporation stock and give them the ability to basically exclude some of the gains. And so for many years there was a lot of different rules around this with regard to the holding period dates and things like that to exclude the gain. The new bill basically throws a tiered approach into that. So the holding period starts after the date of enactment of this new bill, which is July 4th, 2025. And it breaks down into two additional tiers and kind of changes the holding period. So the holding period used to be 5 years. So there's two other tiers now. 50% holding period basically for 3 years. So 50% of the gain can be excluded up to certain limits. We'll go through those in just a minute. If you hold that C Corp stock for 3 years, 75% if you hold that stock for 4 years, and 100% if you hold it for at least 5 years. So you have to kind of think about it from this perspective and say, okay, since this is after the date of enactment, we're talking about C Corps and we're talking about original issuance of C Corp stock after July 4th, 2025. So if you have a C Corp and you already have the original issuance of that stock, and that was prior to July 4th, 2025, you're still under the qualified small business rules that are before this new bill, which basically you're under the 5-year, the $10 million exclusion cap and the $50 million gross assets level. So you can see with this new bill, they also increased a couple of those items. They increased the exclusion cap to 15 million from 10 million. They're indexing these for inflation starting in 2027. And they increased the corporate level gross assets from 50 million, which, was always kind of there, to 75 million. So, what they're trying to do, and Brad, you can talk a little bit more about this as we were talking, but what they're trying to do is kind of stimulate more of, C Corp investments and those kinds of things. But, as Brad can allude to more, it's a trade-off, right? It's a trade-off between all the benefits you get as a pass-through entity and the hope that you're going to be able to sell your C Corp stock and make a profit on it and make a profit to make this worthwhile. So Brad, do you want to add a little bit to that?
Yeah, I think that the Congress Senate have tried to encourage C Corps, but this is labeled, it's been called or nicknamed the angel investor loophole. So you may hear that. It's basically private equity groups that have indicated that that startups and new businesses, they really want to encourage them to be a C corp, but they've now made Code Section 199A QBI, qualified business income, permanent, that 20%, and you don't get that with the C corp. So now it is true that if you hold newly created QSBS stock after the July 4th, 2025 date, that if you hold it 3 years, your tax rate on the overall gain will drop to about 15.9% tax. That's federal tax only. If you hold it 4 years, it drops to 7.9, I think it's 7.95. And then if you hold it to 5 years, it goes away completely. But that's only for federal. It does not apply to state tax. And again, the elimination or the inability to use the pass-through entity tax along with the QBI, qualified business income deduction, I still see pass-through S corps, LLCs, partnerships being the main push for businesses that actually are generating annual cash flow to their owners.
And keep in mind also that 1202 is a very complicated section. There are a number of provisions in order to qualify for this. You must be a C corp. That's a pretty definitive provision. There are ways to be able to have original issued stock through inheritance, things like that. So if you're looking at this, make sure you're not just looking at this and thinking, oh, I qualify. You need to go through all those steps to make sure that you qualify for this, and whether or not you're going to qualify under the new bill, because it does have a number of provisions, not just the originally issued C corp provision. So.
Thanks, guys. Thanks, everyone. We have a lot of questions that came in, so I'm just going to run through them. And feel free, anybody else that hasn't submitted a question yet, we're happy to answer them live here. So first question, if you buy a residential rental property and you do fix up of HVAC system, kitchen, bath, etc., are these improvements able to be written off 100% in year one under the new tax reconciliation bill?
So if you buy a rental property and you fix it up and you allocate some of those costs in a cost segregation to the 5, 7, and 15-year properties under the new bill, that's the nice thing. As long as the rental property is purchased after January 20th, 2025, you would be able to accelerate using bonus and potentially 179.
It might clarify the next step if someone were to renovate or put in new HVAC systems on an existing property.
Yeah, absolutely.
Right?
So if you do renovate and put a new system in, you should be definitely keeping track of the costs that you spent. And I would say, depending upon the magnitude of your renovations, you really should look at it from a cost segregation standpoint, because what you're going to see in a cost segregation standpoint is there's 9 units of property, and we don't have time to go into them now, but you're going to need to break out that property into the 9 units, because that's how you get the 5, 7, and 15-year life. Then when you renovate, you're going to be able to write off certain things as well. So you're going to need to kind of work that through in that. Don't just, renovate and put it all into 15-year or whatever. You need to break it out to get that maximum deduction for it.
Yeah, but be aware that, Code Section 469, you could have a huge loss or push, heavily on depreciation, and not be able to take a dime of it because of Code Section 469, as a, I'm going to call it a passive investor. In rental real estate, there's limitation between 100 and 150,000. You get up to a $25,000 deduction, and that's it, unless you can be classified as a real estate professional, under Code Section 469. So you just have to really analyze it to determine whether or not it makes sense to push the envelope on depreciation on a residential rental.
Thank you. Next question is, doesn't the new tax bill now allow you to fully expense all the way back to 2022 if the business is under 31 million?
Is that a reference to section 174? Is that what they're talking about? I think
I
if
believe-
if you're talking about 174, the new tax bill allows you to do that, but it does not allow you to do that other than filing an amended return. So in your 2022 return, your 23 return, even your 24 return, you're going to have your 174 costs that you were able to deduct, whatever that 10% is typically on a 5-year. You're going to have an unamortized portion that carries over into the next year. You then amortize that. And so as you get through those years, you're going to have an unamortized piece of that. That's what you're going to be able to go back and amend the return to take the deduction for. But right now, the way the law works is if you're under, your average annual gross receipts are 31 million or below, you get to amend that return. If you're not 31 million or below, you don't have that option. You have to take that unamortized portion and choose to deduct it in either the next 1 year or the next 2 years.
That's only capitalized 174 R&D costs in 22, 23, and 24. That's the only thing that you could go back and amend. It has nothing to do with fixed asset or depreciation. There is not any additional depreciation that you can go back and claim.
Next question, is there recapture on the bonus depreciation if the asset is sold?
Yes.
Okay, that's good. If you have an SMB that is C Corp, but have elected the S Corp and sell the company stock, does this count for this deduction? I think that was for 1202 section.
1202? No, you have to be a C Corp.
You have to be a C Corp since day one from
Yep.
the initial
Exactly.
issuance.
That's correct.
Is residential rental property eligible for the qualified business income deduction?
Yes. It's limited to 2.5% of your basically your depreciable tax basis of the assets. It's 2.5%, unless you pay wages, which most rental property, there's no wages. It's just the 2.5% limitation.
If you own a $5,000 SUV personally, can you sell it to your company and get a certain amount of depreciation benefits? And if yes, how much?
Yeah, I think that's 5,000 pound.
Oh, sorry.
Well, that's okay.
It's a
Clarify.
big
Can you
difference.
tell I'm not the
It's-
tax person?
It's a big difference, Ron. I love it. Yeah, it has to be 6,000 pounds or greater
Yeah.
in order to qualify for the 179, 168 depreciation.
And I think what they're getting to, if you own one of those personally and you sell it to your own company, can you take the depreciation?
Well, I think there's a lot of issues related
Yeah,
to that.
a lot of
Is it, what type of entity? Has he claimed it in the past? Then you can look at all different options there, but you need to, there's a lot more in-depth discussion on that.
Right. There's one other here. I don't know if it got answered already, but it was related to on the 179 deduction again, whether or not the property, in specific with the vehicle, does it apply to new and used vehicles for the 100%?
New and used.
New and used. Yeah, absolutely.
Is there a luxury vehicle limitation on vehicle deductions?
Well, the luxury vehicle is, if it's over 6,000 pounds, it qualifies. So, your Rolls Royce, your Bentleys, certain vehicles, I can tell you Range Rovers are over, every car manufacturer tries to hit that 6,000 mark so that they can get 100% deduction. There is a deduction for the, I'm going to call it the financing on new vehicles, but they have to be produced in the US. And that's a deduction up to $10,000 per year for the interest paid on a purchase of a new vehicle. But again, it has to be a new vehicle. and it has to be manufactured in the US.
One final question. Any idea when the ERC documents received by the IRS in 2024, February 2024 will be processed and paid?
Unfortunately, the IRS is not really, they've not really published any guidance on how long it's taking them. What I would suggest you do is call the IRS and find out. The IRS does provide you with some discussion points on if it's in their system, how long it's been in their system. They will not tell you a date when it's going to be paid, but I would say you could probably get as much information as you can by calling the IRS, but no, there is no specific dates they've given. So.
Okay, well, I think that's going to wrap it up for today. Thank you all for attending. We appreciate you for that. As I understand, we'll be sharing the recording and sliding after the webinar, or the slides after the webinar. So you can use that for reference material, and certainly feel free to contact any of our panelists or your main contact at MGO. Thanks again for attending.